Guys, good evening. I hope you can hear me. You can confirm, yes.
Yes.
So we agreed that we shall discuss the question here, question 1. And this is because I got feedback from many people asking me about the question. So I thought I can discuss it with you guys. And then shall look at I statistics. How was the lecture? How was the same? How was tax? Hopefully it was nice. Okay. So this question is an IAS 16 question. It's that component of cost, the last component, which talks about estimation of dismantling costs, or what you call the present value of dismantling costs. Okay, that you have, you want to maybe have what would be the best example? Okay, for the building, that makes sense, but maybe say mining, okay? Now like it is with Hoima, that before the land was fine, flat, people were passing there with their, probably with their cars, okay, maybe there was a road, and now they found that in the land there is oil. So somehow they bought the land and had a contract with the owners of the land, and probably they agreed that after the oil is done, you're going to restore our land to where it was. Now, clearing the land, first of all, that is the cost of its own, clearing the land, and then bring in equipments that do the oil mining and stuff like that, machinery, all that is cost, right? Then, even when production starts and you finish, the entire oil gets done, excuse me, and the entire oil gets done, the company has a task to remove their machines and take them away, and also restore the land the way it was before. Okay, now, estimated cost, because of course, clearing the land, that is an activity in the future. So there's no way you're going to put a cost on that, a complete cost, and say, you know what, I think I'm going to spend 20 million. No, you will say, I think in 10 years from now, that's when the oil will be done. We shall spend, I think, like 50 million in future. So because you're recording the accounts now or the books today, you're supposed to get the present value of that cost, okay, that you're estimating in future, so that it becomes the present value. So that was a task here, that you're given a particular cost, if I may read through, they're saying that on 1st January 2018, okay, here I say you begin with the required, so I beg your pardon. The required says that explain and account for the oil platform in the financial statements of KNOCC or OC Oil for the year ended 31st December 2018. Okay, 2018. They want the books at 2018, right? So here saying on 1st January 2018, this company acquired a newly constructed oil platform along Albertine region at a cost of 500 million, together with the right to extract oil from an offshore oil field under a government lease. Okay, that's the cost of you obtaining the rights of using the land and doing extract. So that is PPE, right? Because you're going to use it for production. You're going to, first of all, it's long term. Secondly, you're going to use it for a long time. And secondly, you're having control over the asset. So clearly you're meeting the conditions of IS 16. Then they're saying that the terms of the lease are that this company here will have to remove the platform that they have put or that they want to construct, which will then have no value, okay, and restore the seabed to an environmentally satisfactory condition in 20 years' time when the oil reserves have been exhausted. All right, so these guys are going to be using this platform for 10 years. Then they're saying the estimated cost of this, of what? Of restoring, okay, the seabed is of this on 31st December 2027 will be 50 million. Okay, 2027 be 50 million. This is 10 years later. Okay, from 1st December, sorry, from 1st January 2018, when you add 10 years to it, you get 1st January 2028. Okay, 1st January 2028, which is the same as 31st December 2027, really. Okay, so it's 50 million. Then they're saying that the appropriate discount rate for this company is 10%. So basically here you're supposed to find the present value of the 50 million, okay, and then do the needful, debit and credit, right? So if I may do that, let me obtain the extract. For now, you can ask any questions if you have. Otherwise, that is really the whole thing. That you're supposed to recognize the cost, but the cost is a component of many things. It includes the price value. In this case, it was 500 million. It includes if there's any discount, we deduct. If there were any installation costs, any whatever, okay, we add. Then including even this one of estimation of what? Of restoration costs, right? So just in a few, my worksheet will be ready. So maybe as I open it out, anyone wants to share with us how we go about our evaluation model under I-16. It's not part of the question, but you can go about it. Anyone? Okay. Looks like
we are not discussing a while ago.
So I'll only do what? I'll only stick to what you guys are interested in. So we're saying the first thing is you're supposed to, okay, our costs, I'm saying it's a component of the 500, okay? What you call the purchase price. Purchase price, what he incurred was 500 million, okay, from the equation. Then we have what you call restoration costs. Okay. Now you appreciate that the price cost, this was a cash transaction really that you paid. You hence debit the asset, hence you're putting it under cost, and credit cash or bank. Now with restoration costs, you don't credit what? Cash or bank. Allow me first obtain the figure itself. So we're saying in 10 years, okay, This is future value. Okay, you know how we get present value. So we have future value. Okay, the figure was, okay, let me confirm again. The figure was 50 million. Okay, 50 million. And then you have the useful life. It's 10 years. All right. So, and this is occurring at the end, okay, the end of the 10th year. Hence, we're saying this is an area. So, how do we find present value? Okay, present value by formula, we just did the FM, right? It's given by future value times 1 plus R, which is the rate, okay, raised to the power negative n. Okay. From FM, okay, it's lump sum, so nothing to think about. Okay, this is the formula. So therefore, we have our figure as 50 million. Let me ignore the zeros, right? Times 1 plus the rate. The rate was 10%, hence 0.1. Raised to the power negative 10. Okay. So that's your present value. So ideally, I'm not doing anything new here. So let me just go through it. Okay. So the answer is 19. Okay. So this is the restoration cost. I just want to bring here 19 million. All right. So, but the entries for restoration costs, like I said, you don't, okay, you have debited the cost, yes, you have debited the asset. Okay. But the credit goes to what we call a provision. Okay, provision for restoration costs. But you have not incurred it immediately. Okay, it's an estimate that expects that you're going to be spending, and therefore you make a provision for it. Okay, that's being prudent, that you are aware that I have a cost to incur in the future, so I should provide for it. Okay, it's usually a form of liability, just to be specific. Okay, you recognize the liability of that. So those are the entries, and they wanted this. Okay, that in your asset, therefore, okay, if I may now put officially the right entries. Okay. The right entries are that you're going to debit your asset. Actually, I can call it the platform. Okay. And then credit cash or bank. Cash or bank. And then credit provision restoration costs. So of course the asset is the entire figure. Okay, initial cost. The cash only paid 500 and the provision is the 19. Okay, so these are the entries that you're doing. So let me remove this. All right. So our extracts, therefore, if I may take you back to the question, what they really wanted, which I think are the extracts. Yes. Wait, I thought I was showing you my screen. Have you been seeing my answer? Kindly confirm. I hope you have been seeing what I was doing. This. Okay. I hope you're seeing what I was doing. Otherwise, I might have been speaking to myself. So just take you back to the question. They're saying explain and account for the oil platform in the financial statements of this for the year ended 31st December 2018. Okay, someone saying, please share. We're not seeing. Okay, so they wanted you to explain what you're doing there and then account for it, right? So the other thing is, you don't stop there. The provision, because of the 10%, it keeps evolving or growing accordingly, all right? And then the 500 million has a useful life of 10 years. Okay, so you're supposed to depreciate the asset over the 10 years. So if I may take you back, therefore, to the solution. Okay, so by doing that, you have just dealt with the provision. Actually, this is at the initial. Okay, this is initial measurement. Remember, under measurement IS 16, you have initial measurement and subsequent measurement. Okay, so this is the initial, that you have incurred the costs just to obtain the rights and therefore have the asset at 1st January. Okay, this was 1st January, 1st Jan 2018. Okay, this is what you do. Now, subsequently, what happens is that these costs keep changing. Okay, specifically for the asset. Okay, remember it's under the useful life of 10 years, or you're going to be using it for 10 years, and it becomes useless in 10 years. Hence, you depreciate this asset based on the 10 years. So therefore, to obtain the depreciation, therefore, okay, depreciation is easy, or it's straight. That we depreciate the asset because you have useful life and the cost and residual value. So it's supposed to use a straight line. Okay. Hence, depreciation is equal to cost. Okay, I want to put that cost over useful life, which is 10 years, giving me 52. Okay, so we know the entry is that you debit P&L, okay, and then credit accumulated depreciation. Okay, so the figure is 52. Okay, cost is rounded off. Otherwise, it will be 51.9. Right, so that's depreciation. Then the other thing is the provision. The provision keeps unfolding or unrolling. The 10% keeps unrolling until that's how it will end up being the 50 million in 10 years. So with the provision, therefore, it goes on increasing with the interest. So we expense it as it arises. So it's the interest, which is the 10%. Interest. Okay. The interest is given by the rate, which is 10%, times not the 50 million, but what you have now as your provision, which is 19. Okay. So giving me 2. Let me just put here the working for purposes of 19 million. Okay. So you have 2. It's supposed to be 1.9, but you have rounded off, so it is 2. Okay, so the entries are that you recognize an expense in the P&L of that interest, and then your provision will increase, hence credit provision for restoration. Okay, this is a liability account, you can remember that. Okay, so hence 2 and 2. So these are the entries. So therefore, my extracts at the end of the year, I may respond to your charts because clearly I'm done. Hello guys, how have we got 52 for depreciation? You divide the cost by the useful life, and the cost is this 5. Okay, let me remove these small places. I think they are becoming an issue. Okay. Okay, so depreciation is cost.
Andrew. Excuse me.
Please go on.
Where are you getting the
Sorry about that, the network. However, I was asking, kindly ask again.
Yes, I was asking where you're getting the 52 flow on depreciation.
Depreciation, you have said you're given the cost. Okay, this is the cost. and you were given the useful life of the asset. They said it's going to take 10 years. And after 10 years, the asset will be useless. Hence, the useful life is what? 10 years. It's here, useful life, 10 years. Okay. So how do you get depreciation? Isn't it cost divided by useful life? Hence, 519 million divided by 10 years, giving us 51.9. You want me to write it here? Okay, let me write it here. Cost divided by useful life. I hope we are now fine. Urona, hope we're fine. Round of.
Okay, thank you.
Okay. So these are the values we have. So of course, with these extracts, we use the journals to show the extracts. So our journals so far, we have this one for the platform, okay, and the asset and provision. Then we also have these that happen during the year, where you have depreciation and the provision. Okay. Hence, I'm saying my extracts, therefore, I'll begin with one of profit or loss. Profit or loss and other comprehensive incomes. That's a statement. So what we have here that affected this, initially there was nothing affecting the profit or loss statement. However, subsequently we have depreciation. So you come here and you say under your expenses, you have depreciation. Okay, we also have interest and provision. Okay, so this will give me the depreciation was already gotten as 51.9. Okay, and then the interest is 1 point. Okay, so I'm done with my profit or loss statement. Which is this one? This is I-16. Esther. I already said this is I-16. Okay. Then we go to the statement of financial position. Of course, there we expect there are usually assets first. Now we have the fixed assets. And the fixed assets, specifically PPE. Okay. We had initially a cost of 519. Okay, 519. Okay, so initially it was 519, but we are deducting accumulated depreciation, which is 51.9. Okay, here accumulated depreciation 51.9, right? So giving me what? Giving me this. Whoever has a video on, kindly remove it. Daphne, kindly mute. Daphne, please mute. So this is your PPE, right? Then you also have cash, but now with cash, whenever they don't give you opening balance, usually you don't really show it. Otherwise, you're supposed to go under your current assets and show that cash is reducing because you're paid. Okay, but whenever they don't give you opening balance, so it's hard for you to really give a balance for it. So usually ignore. However, for provision, you're not going to ignore because that's why in first place they brought the question. So you come here under your liabilities. Okay, actually, this is a long-term liability. Long-term liability. Okay, so we have provision. provision for restoration costs. Okay, now this one also initially it was only 19, but because it accrued this interest here of 1.9, it's going to change, and therefore we're saying a provision is 19 plus 1.9. Okay. So unless you have any questions, that's how we're supposed to do this question. Which standard and where are you exactly? Have you just joined late or something? I already talked about it. I don't want to repeat it. Okay, so guys, unless you have any questions, that is how we deal with estimation of restoration costs under IAS 16. It is under initial costs. Remember, we said by definition, initial costs refers to cash and cash equivalents or the fair value of consideration transferred to bring an asset in its present state and condition for use. Okay, if you don't add that, you won't be correct. Okay, and having said that, the issue of restoration of costs comes in because it is part of the agreement for somebody to give you his right to use his land, especially when he knows that you're going to use it and later leave. Okay, what you call either mining or stuff like that. Like it was with this question. Okay, that you want to come and remove oil from my land and then go after it is done. So what we do is we give you right to mine, yes, but later also give you a task to restore the land to the state in which it was before you left, before you came in. So that is basically what I was trying to explain here. Barbara, please ask your question.
Like me, I'm just putting, how can you access this recorded thing? Because some of us have joined late, so if you could allow us access these recorded versions of yours after you finishing all these. So how can we access the recorded version of this?
Okay, I have a YouTube channel. I usually send what I've recorded. I will still share this. So I'll share with you the link, no worries. Okay, so guys, allow me go to the next topic I was supposed to discuss today, which is IAS 36. Okay, this one is impairment costs. Impairment costs, and what really stands out on this one is the issue of what we call a cash generating unit. Okay, this is the new thing that comes in here. We call it. This is smallest, actually supposed to be identifiable smallest group of assets from which you can obtain cash or generate cash independently. Okay, that's by definition. These definitions, of course, it's either you know it or you don't. Okay, so that's the first thing you need to know about impairment costs. This item here, a cash generating unit, what we call the CGU, okay, is very important. Then having noted that, then it brings us now to what we call impairment costs. Impairment costs, by definition, okay, by definition I know, but in layman's language, I may not really have it clearly, okay? But I can give you a scenario. Okay, we say that something, especially an asset, okay, it is impaired if your expectations are higher than the actual. Once you're having high expectations than what you're getting, then we automatically assume that that asset is impaired, and that's why we normally call in now for what we call an impairment test. Now, in performing an impairment test, that's when you get to know whether the asset is really impaired or not. Okay, but before you do that, the whole thing is you must have suspicion that an asset is impaired. Okay, and there are conditions for that, what we call conditions or indicators. Indicators of impairment. How do you know that this asset is impaired and therefore we should perform an impairment test? Okay, so a typical example is, I would say maybe you have a car. Okay, maybe your car, it's let's say Primo, you have it at 20 million in your books. Okay, and for some reason it is you're always in the garage trying to repair it, and maybe if you're using it for Uber, for example, the Uber guy is not giving you money. Every time he's saying, I'm repairing. Now, ideally, that such a car is impaired, okay, or such an asset is impaired, okay, because you're valuing it at 20 million, and yet your expectations of a 20 million car are really not being met. Hence, we say it's impaired. So we perform what we call an impairment test. Okay, and that one, indicators, like I've already said, I've given you some of those. You read those, read others. Okay? But the one that stands out is mainly on really expected returns, or what you call forecasted cash flows. If they're not really, they are lower than expected, then we say the car is impaired. All right. So how do we therefore determine impairment loss? Because that is when a car is said to incur impairment costs. Okay, let me respond to your chats. I beg your pardon. What's the meaning of impairment? Okay, Cabrin. I've said impairment usually applied on only assets. Okay, and we look at another music for example. If with assets, we expect really benefits to flow towards the entity. Now, if that's not being met, if that is not happening, or if it's happening but at a rate at which you're not expecting. For example, you're saying maybe estimated 20 million in 2 years. Okay, 20 million in 2 years. And halfway during the year, what you're receiving in return is probably 5,000. Half a year, you 5,000, you're expecting 2 million at the end of 2 years. And you're going already half a year, that is a quarter. And you're only having 500,000, not 500,000, you're only having 5,000. Okay, so clearly we say that asset should be impaired or must be impaired. Okay, but you don't conclude like that. You have performed what they call an impairment test. Okay, so I hope I've tried to explain to you what impairment is. Okay, that whenever the actual is not meeting the expected in terms of benefits, then I think you say the asset is impaired. Okay, but that's an assumption. Until you perform an impairment test to confirm that indeed it is impaired, then you can say it's impaired. Okay, so Cabrin, I hope I've answered you as far as the meaning of impairment is concerned. Okay, right. Okay, I'm fair. I'm doing well. I'm doing fair, I think. Okay. So before we look at the question, I can talk briefly about impairment loss. Okay. Now, once you talk of impairment, once you say a number on impairment, has figures. Okay. The things you look out for is one, the carrying amount. Do you know how to compute the carrying amount of an asset, especially if it's a depreciable asset, like say building, a motor vehicle? Do you know how to determine the carrying amount? Okay, and then we compare the carrying amount with the recoverable amount. Okay, what we call the recoverable amount is the higher of two figures. Okay, you have the carrying amount and the recoverable amount. Okay, for you to get the recoverable amount, this one here, you compare two things and get the higher of the two. higher of. Okay. One is what we call fair value less cost to sell. Or you can say dispose. Fair value less cost to sell. In short, you can say it's net realizable value. Okay. Fair value less cost to sell. Okay. Net realizable value is the same thing as you get the selling price minus cost you have incurred in selling. Okay. What you call cost to sell. Then you compare it with value in use. Okay. Value in use is another kind of provision thing, this one here, where you need to use present value and stuff, this one here. Okay, because value in use, what it does is you look at expected future cash flows that you expect to generate from an asset, and then you discount them. You get the present value now, so that becomes your value in use. Now, when you compare the two values, the higher of the two automatically becomes the recoverable amount. Okay, and now this brings me to now impairment. Now, impairment, you only say that an asset is impaired. Impairment. Or impairment cost. Okay, this one actually refers to impairment loss. Impairment loss. Okay. So we say an asset is said to be impaired if the recoverable amount, how much you expect to get from the asset, is less than the carrying amount. That's when you have an impairment loss or impairment cost. And therefore, the loss is given by carrying amount minus recoverable amount. Okay, so that's the impairment loss. There are 2 minutes left on this link, so I will try a number on the next link. Okay, but for now, this is how you determine the impairment loss, and the entries, of course, become now obvious. That you debit impairment loss, or you can say the P&L, because it goes straight to P&L. And then, of course, the asset has reduced in value, hence credit the asset. So these are the entries. Whenever there's a reverse, if you had indications that the asset is impaired, and yet after performing the impairment test, you realize that the carrying amount is less than the recoverable amount, or we're saying that the recoverable amount is greater than the carrying amount, hence there's no impairment loss, you get what you call not an impairment gain, but what you call a gain on revaluation. Okay, takes us back to the revaluation model under IAS 16. Okay, so unless you have any questions, we can wait for this link to shut as we wait to start on the next link, as I get also some questions that we're going to use to attempt to take the topic. Okay, for those who are joining us for the first time, it's the same link we use. Okay, so you just rejoin the same link. Carrying amount